Welcome to another episode of BayView Views. Folks, I'm Mark Dutram. Today we're going to talk about gold. I mean, you're probably hearing about it all over the news and radio shows and certainly commercials. I like gold. It's pretty, it's nice, it's shiny. My wife likes it actually, and it's a tangible asset that we can hold in our hand. Now, gold has been really a long-term symbol of stability and value, but today in the world and its market volatility, inflation fears, we've got digital innovation now. Does gold still have a place in your portfolio? So let's kind of break that down. We'll look at gold's performance as an investment, kind of a store of value, and then a hedge against inflation. So first, let's talk about performance. If we look recently from 2015 through 2025, last 10 years, gold has risen from around $1,200 an ounce to about $3,200 an ounce today. Now, that's a nominal return of about 10% annually, which is pretty darn good, right? Certainly when you compare it to other safe haven types of assets over the past decade. Again, if we look at treasuries, they've returned about 2%, tips just under about 1%, and then of course cash has returned even less. So gold has clearly outperformed, but we've seen interest rates rise recently. Now let's kind of factor in inflation. So over this time period, it actually did pretty well with regards to kind of an inflationary hedge. But if we look at longer term picture, it's really quite different. Gold has been known as a hedge against inflation, but the correlation isn't really perfect. It shines brightest during the unexpected inflationary spikes, kind of like we saw in the 70s. We saw it again in 2021 and 2022. But over time, the connection is really more modest. With an inflation averaging about 3.5% annually, gold's real return was closer to 2%, right? What's interesting, though, is that if you look at the long-term data, you'll see that gold really, it's priced at where it should be on an inflationary adjusted basis today, and that's really kind of after lagging for so many years. So again, as we said, its best performance has really been recently. Also, if you were to compare this to what you might have earned in something like bonds or equities or stocks, you'll find this very interesting. While it was a better hedge than bonds, it was a lower return than equities. Well, you might say that, stocks are riskier than gold, but gold has actually had more down years than stocks over this same time period. So gold has a lot of volatility to it as well. Let's kind of look at gold versus the dollar, because again, that's a really important choice, and we're seeing a lot of that today with cryptocurrencies and things. And we know this, since the 70s, the dollar's value has declined significantly, while gold has actually climbed, as we just kind of looked at. For example, though, you would need about $5.50 today to buy the same basket of goods as a dollar in 1975. So it means dollars lost about 80% of its purchasing power over that time period. You can see, again, quite a bit of volatility in both the dollar as well as gold. And again, as we said, most of the outperformance in gold has been recently, certainly probably since 2019. Back in 1971, President Nixon officially ended the dollar's convertibility into gold, or kind of that gold standard. That moment was known as the Nixon shock, and it moved U.S. off the gold standard. Since then, gold's price has primarily been driven by supply and demand and kind of overall global sentiment. Let's talk about kind of Bitcoin, right? Because that gets a lot of notoriety today. And we hear that a lot. Is crypto replacing gold as a safe haven? Well, not quite. If you look at crypto again, or certainly Bitcoin over the past 10 years, Bitcoin's up, I think, about at 82% annualized. This obviously has come with a lot of volatility. So you have, again, much larger fluctuations than what you would see in the price of gold. So gold offers stability and really kind of insurance. Crypto, at least in its current state, offers probably greater potential, but also greater risk. So they're not really enemies, they're kind of complements. Many advisors recommend allocating maybe a 5 to 10% allocation of your portfolio to gold or commodities or something like this, but not necessarily for growth, but more for protection. Again, for kind of a hedge against uncertainty or volatility, and even as we saw currency risk. So to recap, over the past 10 years, gold has returned, again, about 10% a year in nominal terms and nearly 8% after inflation. And again, this has outperformed treasuries and cash, and kind of why you probably see so many people trying to sell it today. It's really had a good run. I would say be cautious about buying things at peaks, as we often see in many different asset classes. But it does, again, if you look at the data, remain a very compelling store of value in a forever kind of changing world. I hope this helps put, gold in a better perspective for you as an investment and certainly as a store in value. And guys, thanks again so much for watching another episode of BayView Views.